We're honored to have our next guest with us today, Mr. Victor Mendelson, co-president and CEO of HEICO's Electronics Technology Group. HEICO is the world's largest manufacturer of FAA-approved jet engine and aircraft components and related parts, and other than OEMs and their subcontractors, as well as the leading producer of various types of electronic equipment for aviation, defense, medical, telecom, and electronic component industries. HEICO has 84 million A shares, 55 million common. The commons trade at $315 for a $38 billion market cap and $2 billion of net debt for a $40 billion enterprise value. We're delighted to have HEICO with us here today, and particularly Victor. Thank you so much, Victor. Please take it.
Thank you for, is this working? Thank you for having me and having us here today.
Yeah, it was always an honor having you here and HEICO here, Victor. You guys have done a great job. I think probably everyone knows HEICO, but if not, those less familiar, maybe you could just give us an overview of the company's operations, highlighting both the FSG business and the ETG business.
Sure. So HEICO is mostly known for its commercial aircraft aftermarket business, in particular what people refer to as PMA parts, right? So the design, manufacture, and sale of aircraft replacement parts for mostly overwhelmingly the commercial market in competition with the original equipment manufacturers. So we are in that business like generic drugs are to the pharmaceutical industry. When an airplane is designed new, the parts are certificated by the FAA. And whoever gets that certificate is the only approved source to supply the replacement parts. A plane is rebuilt every, let's say, 6 years or so on average, and it needs a lot of parts to do that. And if there's only one source of parts, the original equipment manufacturer, what does a logical, rational person do? They raise prices every year. It averages 6 to 13% a year, regardless of economic conditions, the best times or the worst times. That is where we come in. We sell our parts typically about 30% less than the OEMs. We took over the company actually in 1990. As a few people here, Mr. Gabelli, as you know, we actually had a proxy contest for control. My family, we became, my brother, my father, and I, we became the largest shareholders in the company. It was a small business. It had about $25 million market cap at the time and about $25 million in revenue. And we didn't have any background in aviation or manufacturing or defense world or any engineering or anything we're doing today, but we thought that there was an opportunity in this one particularly unique business. And we thought the company had some cash, it didn't have any debt. We thought we maybe could make some acquisitions on top of that. So we set out to take advantage of that market and to build that market to do something that would be structurally significant in the industry. And it wasn't just looking for kind of incremental gains, it was looking to do something special. The other thing is we always felt that it was about the equity value to us, that if we grew the equity value of the business, we'd become rich, so to speak. And that's been our guiding light. It's building the earnings, building the cash earnings of the business, sustainably, over time, regularly, kind of quarter in, quarter out. Doesn't mean every quarter is great, but I think the overwhelming supermajority of the quarters have been great. So we started with that, and from there, we added at the kind of push from our customers, accessory component repair and overhaul, where we could incorporate our PMA parts. So there are a lot of parts, there are a lot of systems on an airplane, pumps, valves, wheels, brakes, avionics, boxes, things like that, that need to be maintained. As I said, the plane gets rebuilt every 6 years, but along the way, there's a lot of other repair and overhaul activity. It's a huge market. And so we started to acquire businesses and build those in the accessory component repair and overhaul space. And today, I believe we're the largest accessory component repair and overhaul business, independent, that is, in the U.S., and then we added distribution to that. So we found adjacencies where there were very entrepreneurial and special opportunities to grow, and that were growing businesses, and we added those, keeping the businesses fairly autonomous right? That's been a hallmark for us. It's very important, where we keep the entrepreneur, founder, manager running the business, right? So that what was special before remains special. We're not trying to remake it. We're not a turnaround company, for example. And we've added to that then structural components and other composite parts that are added to aircraft defense equipment, and space applications. And that's mostly in our flight support group. And then you asked, of course, about the electronic technologies group. And it's been a similar strategy. We set out to acquire component and subcomponent manufacturers that are critical items in something else. So we're not at the top level of a bill of materials. We're not at the top level. You're not going to fly off in something that we make. You're not going to launch something that we make. But something that we make will be absolutely critical, absolutely required in flying off or launching off or something like that. Is that a good kind of high-level summary?
I think you cut right to the essence of this industry. Very, very good.
And it's, by the way, it's about cash flow. I mean, that is what really matters the most. My father was a CPA early in his profession, and he said he learned very early on that there are three things that matter in a business: cash, cash, and cash. So that is hyper important to us. And so you look at how we evaluate the business, we look at, when we make an acquisition, what we call EBITA. A lot of people do the same, which is after depreciation, right? We consider depreciation a real expense because that's a proxy for CapEx. And you got to fully burden the business. And we're, as you know, a high cash generating business.
Very nice. Let's jump right into the ETG business. How are you viewing the primary growth drivers in defense, particularly from specific programs or emerging areas, especially considering the record net sales that you just had in this previous quarter?
Yeah, we have record backlog at HEICO, period, including in the electronic technologies group, and most of that is defense. Most of that's driven by defense, and it's broad-based, fortunately. It's across, we do a lot of things in defense. Again, for HEICO, we don't want to be like everyone else. We want to go where niches, we want to go where the niches are, where we think that there's something different and something special, lower volume. We're not looking for high volume, high revenue. We're really concerned with the profitability and cash at that. So if you look at what we do, it's a variety of things, and it's broad-based in that backlog. For example, we're a leading manufacturer, probably the leading manufacturer of aircraft antennas, and antennas used in missiles and precision-guided munitions. That's a growing business for us, and I think a lot of upside potential to that. We make a number of things that are tied to missile defense, both on existing platforms, and people talk about Golden Dome. If you want, I'll kind of get that one out of the way. I mean, it's not extremely well defined, but there are a lot of components to Golden Dome that will be existing systems and existing technologies. A lot of people talk about PAC-3, Patriot 3, Patriot 2. Those are both programs for us. Not so much necessarily at Golden Dome, but certainly over in Israel. The Arrow 3 missile, we make some critical components on that. Standard missile, and a number of others that are in development. And then layered on top of that, a space tracking, right? And detection, both space, airborne, and even from the ground. And we've won some contracts of late in some of our businesses, which we believe are tied to that. They don't always break it out and identify it. So if I look at all those things, I look at our fuel systems business as well, big backlogs there, as well as a lot of other components, kind of broad-based.
And you went through that very well. And just maybe you could just give us sort of where each of those are these some of these components, are they growing faster than others? Like, where is the focus right now, would you say, if you were going to pick one in the ETG business? I know you have a lot of parts in that business.
And I'm not being cute on this, or not trying to evade the question. I think it's equally across the board. That's the beauty of our setup, right? I talked a little bit, I mentioned that our businesses remain fairly autonomous. They're affiliated, and the management stays. It's the same name on the door after we acquire. We've acquired over 100 businesses since we started buying businesses. 80% from the entrepreneur, founder, managers, right? And so they focus heavily on what they need to focus on, and it doesn't come from on top. So they don't get a decision from me that says, okay, this sounds like the next big new thing, and I'm the guy with the least knowledge, right? I'm the guy who knows the least about the customers and what they need, in truth. And, I'm going to decide for you. So we do it the other way around. It's ground up. They're the ones talking to the customers, and they sense and see the opportunities and go for it.
And then maybe on a OE aftermarket split in the ETG business, could you tell us how that plays out? How much OE is there in the ETG business versus aftermarket?
Yeah, I would say at this point, because we've added some more commercial aviation, that we probably have about 10%, maybe 15% would be aftermarket, what people would think of as aftermarket in the ETG, and the rest would be OE. And that has always been the case, and we're probably at a high point now, a historical high point, so record, if you will, on aftermarket content.
And then, I've asked this before, but maybe any changes is opportunities to have PMA in the ETG business. Is that an opportunity that could happen like the FSG business, or?
Good question. I don't think so. I think we would pursue that through the flight support group. Now, we may make it, right? We may do the engineering and design in the ETG, and maybe even the PMA holder may be in one of the ETG companies. But I think we'll do that kind of strict aftermarket through the flight support group, because it's something that was pioneered there. I mean, created that field, and that's where they're particularly close to the customer.
What do you? You sort of talked about Golden Dome, but how is ETG positioned to adapt to potential shifts in the defense budget? Obviously, we just saw our first $1 trillion defense budget in this new administration. Could you sort of walk the dynamics of since the new Department of Defense has come in? What are you seeing on proposed maybe increases, decreases in your business?
Yeah, so right now it's strong, obviously, it's healthy. And remember last year I was here, it was 2 months before the election we were talking about it. I said, look, I think if Trump wins, he kind of gets peace through strength, and that will be good for the defense budget. It's played out that way. But there are winners and losers. And even within our company, there are winners and losers. There are some things that have been, they're not big, but, I'll hear every few weeks about something that got canceled, $100,000 here, $200,000 there, again, not material. Fortunately, it's more increases, more plus-ups, and more new orders than we're seeing in cancellations. But again, it's more or less for us broad-based, and it's hard to get out and anticipate exactly what's going to happen with next year's defense budget and what the priorities will be. So our strategy is to be extremely responsive, to maintain product development consistently in engineering, and just keep doing what we've been doing and kind of work through those surprises as they come.
Maybe moving to margins, ETG continues to show higher margins compared to the FSG business, which is notable in a defense-oriented business. How do you think about sustainable levels, and maybe what factors contribute to these higher returns versus your peers? You've obviously outperformed.
Yeah, look, and the margins move around in the ETG, as you know, and they will continue to do that. We focus, as I said, on EBITA margin, the GAAP margin, which strips out amortization, which really is just a phony number that, my opinion, if you've got businesses that are growing and doing well, it's just the phony number you're stripping away. So we look at the actual cash number that the business is generating. For ETG, it's going to be volatile. I think it will continue quarter by quarter based on which business has higher shipments in a given period, because we have some very high margin businesses in there and some lower margin businesses, and it just depends on the mix that we're experiencing. And that's why I look out over the period of time, and we say that the EBITA margin that we're looking for out of the business is in that 26 to 28% range. On a GAAP basis, 22 to 24% range. I think that's reasonable. I think that's very sustainable. It will be influenced by acquisitions. So if we make an acquisition, obviously that's below that threshold, but still healthy margin, it'll bring that margin down. And obviously, the converse is true. We'll buy something that has a higher margin, brings it up. I'll give you an example, by the way. I mean, we bought this company, Excelia, in France. We closed in January of 2024, right? We signed the acquisition in the summer of 23. We said it's a lower margin business than the ETG average. It's going to be dilutive to the margin, but it's going to be very profitable. It's going to be very accretive. And we were very excited about what it could bring us in Europe. Right? It's based in France, obviously. A big chunk of their business is defense. And sure enough, that's come true. It's diluted the margins, to be sure. It's a couple hundred basis points. Now a little less, their margin is rising, so maybe it's 150 basis points or so. But I do that all day, every day. I mean, the business is paying for itself really well, generating a lot of cash. So I was looking at an acquisition we're working on. Very good business, 26% operating margin, which is EBITA, right? They're making 25.5% now. And I look at that and I say, oh, that could be dilutive to where we want to go with the margins, but it's still a great business. So we'll do that. But we buy higher margin companies as well.
I remember you just bought that. We were at the air show.
Yeah.
That's right. Let's talk about R&D needs. Where have the largest investments been focused in recent years? You talk about a need for, designing these new parts, designing these new businesses. How much R&D is needed, particularly on advanced electronics and sensor technologies?
Yeah, so taking the two sides of the business, I think that all in HEICO's, our ETG R&D spend is somewhere pushing 6%, somewhere in that range. And in our flight support group, it's a little shy of 2%. And I think you average it out, it gets you about 3 or somewhere around there, 3.5% spend. And even within our flight support group, remember we have a very nice distribution business where there's zero R&D when you're distributing someone else's product. So if you separate that out, they're probably more comparable. So it's across the board. Again, it's that idea the businesses decide where we're going to invest, but that's the rate at which we're investing. And it's not a target, by the way. We invest whatever we think we need to invest. And if that number were, our companies came in and said, well, it's going to be 4%, it'd be 4%. And if the number were 8%, it'd be 8%. But we have to generate new products constantly or else we die. But we have to do it efficiently. Like, we can't be sloppy, and we can't also, we're not a venture capital firm, right? So it's not about, hey, I got this great idea, let's see if the market will take it. We're responding to specific demand, specific need that our customers articulate to us.
And with that said, are there opportunities, you talked about, produce or die or build or die. Are there opportunities to accelerate, maybe in light of what's happened in the last 3 years, to development cycles within ETG on new technologies or partnerships?
There may be some. I think we go reasonably quickly, and we follow our customer demand, but there may be some out there. There's nothing notable that comes to mind, though, at this point.
Could you discuss any potential, you talked about there's some lumpiness and it depends, but one-time items or factors that could challenge sustaining ETG margins going forward? Sure.
The things that historically have challenged us are exogenous events, right? Something, COVID or, financial crisis or something like that we can't really foresee, so we don't plan for those. And those are kind of the most likely ones. But there is the day-to-day. I mean, where you get behind in a program, there's a failure in some test or some engineering, or you have some key engineers quit, or key engineer or salesperson. However, given the breadth of what we do and the design, the way we're designed with so many subsidiaries across so many businesses and locations, the likelihood that problems at any one subsidiary would be material is pretty remote. It affects us. I mean, you'll have there's a fire or something like that, right? And that business is out of commission for some period of time, and it hurts, and it's somewhere in the margins, but is not usually material.
Maybe looking at M&A, how do you approach, you've done so much M&A over the years, and maybe you could talk about your methodology, approach the size of potential deals and your strategy. I mean, you haven't really done a public company that I can remember, versus maybe larger, smaller bolt-ons. How do you look at that?
Yeah, so we're opportunistic. We want to buy companies that are accretive, right? Accretive to earnings, accretive to cash in particular, but businesses that have legs, they're not a flash in the pan. It's not having a great year or two or three, and then it disappears. We want to buy niche businesses, as I said before, somebody doing something special. And our preference is to buy from the entrepreneur, founder, manager who has created a culture like ours. Culture is very, very important. We want people who are motivated, who are really energized to come in the morning. It's not just some corporate matrix, and I'm going to work until I get my next promotion and my next promotion, and then I'm going to retire. That's not us. We're completely different. You can only make so much if you fall within this box. We've acquired your company, and therefore everybody's getting a change in pay. We don't do that. We like the people who want a great home for the business, where the name stays the same on the door, where they can continue running it. Usually they're our partners. They'll own 20% or so. So that has been our most fertile territory in two ways. One, in number of deals, and of course the economics, but two, in success. Those have been our most successful deals. By the way, sometimes they're available from private equity, but usually not. And so we'll continue to look at all those. We'll look at different sizes. We'll buy everything that makes sense and nothing that doesn't. So if there's a year where we don't find anything sensible, we're not going to buy anything. And if we find 10 things that are great, we'll buy those 10.
You've had a pretty good track record. Maybe with that being said, any updates, and there have been some other discussion before about the size and quality of the current M&A pipeline funnel, especially with your strong performance so far in 2025. How does the market look right now?
Very robust. We are overflowing with deals, transactions that we're working on right now. It really is remarkable. I didn't think it could get more robust than it was, but it has increased dramatically in the last several months. I'm not quite sure why. Most of those are entrepreneurial companies, entrepreneur-led, owned. There are some we are looking at carve-outs, and some private equity as well. So it's the full range. I never know what we'll buy. I remember making that comment last year, and I think the year before. It's like, if we bought all that we could, we'd spend X, but that's highly unlikely because most don't work out.
You talked about the Excelia deal, but could maybe some of your more very recent acquisitions. You've had quite a few actually. Could everything from Rosen Aviation to the aerial delivery, descent systems from Capewell, and then earlier deals like Honeywell's display business and Wencor, of course, your big one. Could you talk about maybe how those ones have performed very recently?
They've all performed extremely well. Some at our expectations, some above. Some very well above. I don't think any have performed below the expectations. And there was a strategic reason for each one of those transactions. Like, you look at Mid-Continent Controls and then Rosen Aviation. We had an opportunity to buy and partner with a very successful electronic component maker for the bizjet market that would go into one of our companies. And very profitable, very successful business, great name, reputation in the industry. And we bought it, and soon thereafter, another opportunity came up, and that became, that was Rosen Aviation, became part of Mid-Continent. And so far, that's been, just been a home run for us, and we're looking for more that fits within that because we've got great entrepreneurial management. That's really a lot of what we look for. The Honeywell displays business and the other Honeywell businesses have gone extremely well for us. I think we've added very well to those businesses beyond what the projections were. The one that Excelia bought, SVM, falls in that category. The Gables Engineering acquisition we recently completed, that is a truly unique company, as you heard us talk about on the earnings call. If I'd had my druthers, we would have closed on it 6 or 9 months later than we did. I mean, that was, but there was, the opportunity won't be there in 6 or 9 months. They were willing to sell to us. They wanted to sell to us. They had a lot of people in the industry. Everybody wanted to buy it. And so it was kind of a now or never thing. And that business has aftermarket content on a huge array of airplanes. And it's been in business since 1946. I mean, their panels in planes, it's a generic term like Kleenex. They refer to it as a Gables panel in a lot of planes, right? I mean, so we make the Gables panels like we make Kleenex. And but they're doing a lot of new controls and displays in Boeing aircraft. And a couple of years ago, they had a huge year, shipped a lot to Boeing. Boeing is working off that inventory, and I'm guessing 6 to 9 months based on the data we have, that starts to be extremely profitable for us. And then they've also designed in a new touchscreen control display unit, which will be the standard, which will be installed on all Boeing 737s going forward. And there's a retrofit market for us as well there. So that is exciting. And there's another piece I've talked a little bit about. It's in a unique location. It's just what grew up around it in South Florida, where it has a large amount of property in what would be like almost 5th Avenue and 57th Street. Imagine having a factory there. And so there's a lot of value in that land, huge value in that land. Not for now. We're not going to move it. We're going to keep people where they are. But eventually it will make sense for the workforce. The workforce is going to be entirely from a different part of town. So that will be monetized, and that will be should be a very meaningful amount of the purchase price.
That's very nice. Maybe I'd open it up to the audience for questions.
Only easy ones.
Could you talk about how Wencor may or may not have kind of changed the trajectory of the company and maybe kind of notched up your aftermarket position, and how you see that rolling out? A little bit on pricing as well, whether you've taken some, and what explains the fact that you guys have outperformed on organic growth and aftermarket relative to the 2 or 3 periods by a significant margin. Thank you.
Just brilliant management. Taking it back, what explains the alpha, if you will, on the aftermarket? Start with that. That is, it's a variety of things. The biggest one would be new product and repair, development and introduction, right? It's just we should grow at more than the market because we develop more and we come out with more than the market. We get the market growth plus our product development, and that includes DER repairs. So I think that would be the biggest explanation, and that's something that is always the case, I believe. Not always the case, 90% of the time or something like that, but an overwhelming portion of the time is the case. And that, by the way, drives margins as well in those businesses. I think we've had very good, I'll call it broadly, absorption, expense absorption and overhead absorption there as well. Does that give a good overview of how we see it? And I would expect, we've had a lot of new opportunities because we've gotten to a certain size. We're getting more opportunities. I think we're getting more respect in the market, more, it's more credibility. I think we had credibility before, but it's kind of hopped to a new level. I'm sorry? And Wencor, Wencor definitely added to that. I mean, it has increased the trajectory, no question about that. It's been a great acquisition, as we've talked about on our earnings calls and elsewhere. It has performed well beyond what we thought it would do.
Yeah. Well, Wencor has been a huge home run.
Huge.
Victor, thank you for being here today. Oh, I'm sorry.
We'll do it later, Victor. I was just, can you find any way to tax deduct your amortization? You got $500 million of amortization. Is there a new version in the tax bill?
I don't think there's a new version in the tax bill. Some of our amortization is deductible, but a lot of it isn't. And it all depends if we do a stock deal or an asset deal. You know it well, yeah.
You've managed it so well, Victor,
Thank
you and your team. Congratulations on all your successes and being in the rarefied air of Berkshire. And we hope to have you back next year.
Well, I feel honored to be in the rarefied air of Gabelli Gamco universe for a long time, and we're very grateful for your friendship and support, confidence all these years.
Thank you, Victor.
Thank
Well done.
you.
Investors should carefully consider the investment objectives, risks, charges, and expenses of the ETF before investing. The prospectus, which contains more complete information about this and other matters, should be read carefully before investing. To obtain a prospectus, please call 800-GABELLI or visit www.gabelli.com. Risks to the ETF include a downturn in commercial air travel, production and/or supply chain disruptions, decreases in defense spending, subcontractor financial health, and competition and/or technology changes.